Welcome to Alfonso Cajero, Financial Modeling Tutorials. Chapter 2, Understanding Discounted Cash Flow, DCF, Analysis, Formula, Examples, and Practical Application. In this section, we will delve deeper into discounted cash flow, DCF analysis, by examining its formula. Understanding the formula will clarify what drives DCF analysis and how to build it in Excel. For a more comprehensive guide, I recommend our financial modeling courses, especially Fundamentals of Financial Modeling and Building a Financial Model in Excel, which provide detailed instructions on constructing a DCF model from scratch. Consider an example of a cash flow that occurs in 2018. The discount factor formula is 1 plus rate, number of periods. With a rate of 10% and a period of 1, the discount factor for the cash flow in 2018 is calculated. For a cash flow of $100 in 2019, the discount factor is raised to the power of 2. As illustrated, the present value of the cash flow diminishes over time. By 2020, the present value of a $100 future cash flow is reduced to $75 today. In 2021, it is worth $68, and in 2022, it drops to $62. A DCF analysis also includes a terminal value, representing the business's value into perpetuity beyond the forecasted period. For example, if the terminal value in future cash flow is $300 and is raised to the power of 5, its present value today is only $186. This shows that while the future value can be substantial, its present value is significantly lower. To calculate the firm's entire value, sum these present values, resulting in a present value of $565 million compared to a future value of $800 million. Next, let's explore the cost of capital formula, which depends on a business's capital structure and risk level. A company's capital structure comprises debt and equity, which fund its assets. The cost of capital is calculated by considering the proportion of debt and equity and their respective costs. Summing these contributions gives the total cost of capital. For a practical example, consider a company with 14% debt and 86% equity. If the after-tax cost of debt is 3.5% and the cost of equity is 9%, the weighted average cost of capital, WACC, is 8.2%. This WACC figure is used in the DCF formula to calculate the present value of the business. Instead of using 1.1 as in the previous example, the formula would use 1.082 raised to the power of the respective year or period being discounted. These concepts can be challenging initially. For more detailed explanations, I highly recommend exploring our other courses on the cost of capital and financial modeling.